This is Optimal Finance Daily, episode 1871. You Can Win with Stock Market Losses, Part 2, by Tyler Weaver with Fiology.com. And I'm your host and personal finance enthusiast, Diana Merriam. Today's post is actually a continuation from yesterday. So if you're new here, it'd be best to listen to yesterday's episode first. But if you're all caught up, let's hear Part 2 and continue optimizing your life. You Can Win with Stock Market Losses, Part 2, by Tyler Weaver with Fiology.com. Noncorrelated assets. Anyone invested in the 2008 meltdown remembers how everything they owned seemed to go down at once. Investors who thought they had diversification quickly discovered they weren't as diversified as they thought. Whether you had U.S., international, or emerging market stocks, everything went down dramatically. So what can investors do? Add non-correlated assets. That means adding investments that tend to go up or at the very least don't go down when stocks fall. Treasury and government-backed securities. Treasury securities, either directly purchased or via funds and ETFs, are not correlated with stocks. Those who had treasuries and other government bonds in their portfolio had much smaller losses than those who didn't. Corporate and high-yield bonds did not provide the cushion that government bonds provided. If you're invested in an all-stock portfolio, consider adding some treasury securities. Real estate. Real estate is another asset class that's often not correlated with the stock market. If you have the cash and inclination to do so, rental properties can be an excellent real estate investment. You don't have to watch them go up and down like the stock market. They're not liquid. You can't sell them quickly for cash as you might impulsively do with stocks on a bad emotional stock market day. Depending on the market, they can provide nice growth without the volatility of stocks. The opportunities in real estate are limited only by your capital, knowledge, and creativity. You may have even thought about renting out a room in your house for extra income. Before you jump in, just know there are many different ways to build wealth using real estate. If interested, first do plenty of research and even find a mentor with proven success using the methods you envision for yourself. It'll save you a lot of money and headaches. One way to invest in real estate is through real estate investment trusts. Called REITs, these can be in the form of publicly traded or private securities. Publicly traded REITs are more income-oriented than growth. They are a good option for an asset that's not highly correlated with stocks. Private REITs are another excellent option. These REITs have recently become available to smaller investors through crowd-funded REITs. One of the more popular options comes from Fundrise. They offer income and growth, and growth options. They've been around longer than most other crowd-funded REITs. Keep in mind that these private REITs are not liquid. Access to your investment is limited. Count a minimum 5-year holding period for this money. Alternative non-correlated assets like real estate should be a small part of the portfolio for most investors. Along with government and treasury securities, they can offer a cushion to your portfolio in a falling stock market. Rebalancing to mitigate stock market losses. Rebalancing is something we hear a lot about with little explanation about how or why it works. It starts with an asset allocation strategy. That strategy sets target percentages for each asset class in the portfolio, like stocks, bonds, cash, etc. At its core, rebalancing means selling assets that have increased above a target percentage and buying assets that have fallen below the target level. 5 benefits of rebalancing. Number 1, it can give you peace of mind. Having a system in place to manage the ups and downs of the market means you don't have to look at your portfolio every day, or at least you shouldn't. Knowing this should allow you to stay much more calm about your portfolio. Number 2, you will systematically be buying low and selling high. And isn't that the key to successful investing? You may not have the money to buy a few $1 billion of Goldman Sachs and a few other companies like Warren Buffett in 2008, but you'll be selling funds that have gone above their limits and putting money into additional funds whose value has fallen. Number 3, you will better manage your risk. Selling what looks like winners to buy what appears to be losers seems counterintuitive. However, if you follow this discipline, your portfolio will stay within the risk levels you decided worked for you. Number 4, it will be easier to stay on track for your goals. Portfolios need to match a goal. Otherwise, the temptation to chase some arbitrary return may cause you to make bad decisions and make unnecessary changes to your investments. And number 5, it'll be easier to get through bad markets. Those with a system in place during the last financial crisis came out further ahead than those who didn't. During that time, money poured out of stock funds and into the Treasury and other government securities. Those with rebalancing in place did just the opposite. They were buying stocks and funds during that time while selling the fixed income that went up. That's a textbook example of why it works. Final thoughts on stock market losses. Investing can be as simple or complicated as you want to make it. The best way to invest at the lowest cost is with index funds. Whether you're a newer investor just starting or a seasoned investor who's been investing for decades, it pays to review your goals and strategies regularly. Circumstances and life changes happen. The goals you set for your investments initially may have changed. Never invest in stocks for the short term. Few ever win that way. The losses can be devastating. Short-term money should not be in the market. Forget the return you're losing. Think about the principal you could lose. Many investors got hit with heavy losses trying to chase returns from a hot stock or fund. It's nearly always a losing proposition. Take the long view. There's money to be made in the markets over long periods. Set your asset allocation, put target high and low percentages around those targets, and rebalance when they get outside those targets. Then sit back and watch the pouting pundits of pessimism, a quote from Brian Wesbury, tell you how bad things are and how much worse they're going to get. After all, bad news sells. Good news is not newsworthy. Turn off the financial press unless it's for entertainment. Sit back and relax, knowing your plan is in place and you've set yourself up for the best chance of long-term success. You just listened to part 2 of the post titled, You Can Win with Stock Market Losses by Tyler Weaver with Fiology.com. It seems to me that when you have a long-term approach to investing, the volatility of the stock market likely has less of an emotional impact. During a stock market correction, I typically see 2 reactions. Some people panic sell and talk about how much money they lost, and others talk about how they're investing more because, quote, the market is on sale. If you're investing over a long period of time, it's much easier to see a market correction as a good thing because it allows you to buy more shares for the same amount of money. And since the market has historically always gone up over long periods of time, a correction, especially earlier on in your investing career, can be a very good thing. But waiting for the bottom of a stock market dip is also another common reaction. I think it's important to remember that you'll almost never win by trying to time the market, and that time in the market is much more effective for building wealth. The strategy of investing regularly, regardless of what the market is doing, is known as dollar cost averaging, and it reduces the impact of volatility on the overall purchase of your investments. This strategy moves much of the detailed work of attempting to time the market in order to make purchases of equities at the best prices. A great example of this strategy at work is with a 401k. You're making regular contributions from every paycheck, regardless of what the market's doing. Dollar cost averaging guarantees a mathematically favorable average price for your investments because you're buying at both the highs and the lows. It also pairs well with a long-term passive investment strategy. It truly allows you to invest it and forget it, And there are lots of calculators online that you can use to compare this strategy against lump sum investing. And that's another episode and weekend of Optimal Finance Daily in the books. I'll be back with more posts for you on Monday. So have a great rest of your weekend, and I'll catch you tomorrow where your optimal life awaits.